On September 15, 2009, the lights went out in the flagship Gottschalks store on Sacramento's historic K Street, and a silent auction sign flickered on the windows, marking the end of a 115-year-old American retail legend. Born in a modest five-room storefront on Stockton's Broadway in 1904, Gottschalks began as a single-family dry goods shop founded by August Gottschalk, a German immigrant with a simple promise: equality for the common man. By the 1930s, the store had grown into a regional fixture, expanding its product lines to include apparel, home decor, and electronics, while retaining the personal service that set it apart from the sprawling department houses of the East Coast. The post-World War II boom propelled Gottschalks into the suburbs, and in 1955 the first off-mall location opened in a burgeoning shopping center outside Fresno, a daring move that foreshadowed the chain's future strategy. Through the 1960s and 1970s, Gottschalks rode the wave of California's population surge, opening stores in Sacramento, San Diego, and the Central Valley. The company's identity, mid-priced, family-oriented merchandise paired with a reputation for attentive sales staff, earned it a loyal customer base that often referred to the stores as the neighborhood mall. By the early 1990s, Gottschalks boasted more than 50 locations and had entered the public markets, raising capital through a modest IPO that funded an ambitious acquisition program. In 1998, the chain bought 3 former Harris Warner stores in Nevada, and in 2000 it acquired the defunct 18-store chain, Lamont's, adding a swath of underperforming malls to its portfolio. The expansion, however, came with a hidden cost. Each new lease required heavy upfront cash outlays, and many of the acquired sites were situated in aging shopping centers already losing foot traffic to big box retailers and emerging online giants. To finance the growth, Gottschalks leaned heavily on debt, issuing high-yield bonds that carried interest rates well above the market average. By 2005, the company's balance sheet listed $850 million in total liabilities against $1.2 billion in assets, an acceptable ratio on paper, but one that left little room for error when consumer confidence faltered. Early warning signs began to surface in the mid-2000s. Same-store sales, a key metric for department stores, slipped from a steady 3% annual increase in 2003 to a stagnant 0.5% by 2007. Inventory turnover slowed, and the chain's average ticket size fell as shoppers turned to discount chains like Ross and TJ Maxx for deeper bargains. Meanwhile, the national recession that began in December 2007 eroded disposable income across the West Coast, and Gottschalks' core demographic, middle-class families, felt the pinch most acutely. In the quarterly report for the fourth quarter of 2007, the company disclosed a $45 million loss, its first annual deficit in 3 decades, and warned investors of increasing pressure on margins. The debt that had once powered expansion now became a stranglehold. In early 2008, Gottschalks missed a $30 million interest payment on its senior notes, triggering a covenant breach that forced the lenders to demand immediate repayment. The company's chief financial officer announced a restructuring plan that would close underperforming stores and renegotiate lease terms. But the plan required an infusion of fresh capital that investors were unwilling to provide amidst a tightening credit market. By October 2008, the chain had slashed its workforce by 12%, shuttered 9 stores, and sold off inventory at deep discounts in an effort to generate cash. The final blow came on January 16, 2009, when Gottschalks filed for Chapter 11 bankruptcy protection, listing $1.1 billion in debt and $700 million in assets. The filing revealed that the chain owed $340 million to a consortium of banks led by Bank of America, $120 million to vendors, and $200 million in unpaid rent across its leased properties. The bankruptcy court appointed a trustee to oversee liquidation, and within weeks, the company announced that it would close all remaining 58 stores, laying off more than 7,000 employees in a single, devastating stroke. The aftermath rippled far beyond the empty storefronts. Small towns that had relied on Gottschalks as a retail anchor saw foot traffic evaporate, leading to a cascade of vacancies in surrounding malls. Former employees faced a sudden loss of health benefits and retirement contributions, sparking a class action lawsuit that would linger in the courts for years. Real estate developers quickly snapped up the vacated leases, converting many sites into discount outlets, fitness centers, or mixed-use complexes, effectively erasing the Gottschalks brand from the physical landscape. Yet the memory of the chain lingered in the collective consciousness of Californians who had grown up with the familiar blue and white signage, the seasonal holiday displays, and the personal greetings of sales associates who knew customers by name. In the broader retail narrative, Gottschalks serves as a cautionary tale of overextension in an era of rapid market disruption. Its rise from a single-family shop to a regional powerhouse demonstrated the possibilities of strategic growth, but its collapse underscored how fragile that success can be when debt outweighs cash flow, and when a retailer fails to adapt swiftly to shifting consumer habits. Analysts point to the chain's reluctance to invest early in e-commerce platforms, its dependence on aging mall locations, and its underestimation of the competitive threat posed by online giants as pivotal missteps that accelerated its downfall. Today, the Gottschalks name survives only in the annals of business case studies and in the nostalgic recollections of shoppers who still keep a faded receipt or a seasonal catalog tucked away in a drawer. Subscribe to The Collapse for more stories like this.